If your superannuation balance is under $3 million, this video could still save you thousands of dollars this year. And if it's over $3 million, this video could save you a lot more than that. Because from the 1st of July 2026, the rules around your super just changed in ways that almost nobody has fully explained yet. Not your accountant, not your fund, and definitely not the letter the government sent you that you probably didn't read properly. Stick with me for the next few minutes, because by the end of this video, you will know exactly what changed, exactly what it means for your retirement, and exactly what you need to do about it before the financial year gets away from you. Welcome back to Centrelink Age Pension, the channel that cuts through the confusing government jargon and tells you what actually matters for your money and your retirement. If you're new here, hit subscribe, because we cover these changes the moment they happen, not months later when it's too late to act. And if you've been with us a while, you already know we don't do fluff. So let's get straight into it. Let's start with the one everybody assumes has happened, but actually hasn't, the super guarantee rate. For years now, we've watched this number climb, 9.5%, 10%, 10.5%, 11%, 11.5%, and finally 12% on the 1st of July 2025. A lot of people assumed there'd be another bump this year. There isn't. The super guarantee rate is staying at 12% for this financial year, and there's no legislated increase currently on the table. So if you've been waiting for your employer's contribution to jump again, it's not happening in 2026. 12% is the number, and it looks like it's here to stay for now. But here's where things get genuinely interesting. Because while the rate hasn't moved, the way that money reaches your account has completely changed. This is called Payday Super, and it is arguably the biggest structural shift to superannuation in over a decade. Under the old system, your employer only had to pay your super into your fund at least once every 3 months. Think about that for a second. Your money could sit with your employer for up to 90 days before it even touched your super account, not earning you a cent of investment growth the whole time. From the 1st of July 2026, that changes. Employers now need to pay your super contributions at the same time they pay your wages, with a short window of a few working days to make sure it actually lands in your fund. What that means for you in practical terms is your super starts compounding sooner. Every single pay cycle, your money is working for you instead of sitting idle. It also makes it far harder for dodgy employers to quietly skip or delay your contributions, because underpayment becomes visible almost immediately instead of being buried in a quarterly statement you might never check. If you've ever worried about unpaid super, this change is arguably the single best protection introduced in years. Keep an eye on your payslips and your super fund app over the next few pay cycles to make sure your employer has actually made the switch properly. Because with any big system change, there will be teething problems. Now let's talk about the numbers that matter if you're actively trying to grow your super balance. Because these caps just went up, and if you're someone who likes to top up your super with extra contributions, this is genuinely good news. The concessional contributions cap, that's your before-tax contributions, including what your employer pays in and anything you salary sacrifice, has increased from $30,000 to $32,500 for this financial year. That's an extra $2,500 you can now push into super at the concessional tax rate before you start paying your full marginal rate on it. For a lot of higher income earners or people trying to catch up on their retirement savings later in life, that extra headroom is meaningful. The non-concessional cap has moved too, from $120,000 up to $130,000. That's your after-tax contributions, money you've already paid tax on that you're choosing to add into super anyway, usually because of the tax advantages once it's inside the system. And if you're someone with a total super balance comfortably under $1.84 million, you can still use what's called the bring forward rule, which lets you contribute up to 3 years worth of that non-concessional cap in a single year. Under the new numbers, that's up to $390,000 in one hit if your circumstances allow it. If your balance sits between $1.84 million and $1.97 million, that bring forward amount scales down. And if your total super balance is above $2.1 million, your non-concessional cap for this financial year is effectively zero, and the bring forward rule doesn't apply to you at all. This is exactly the kind of detail where getting professional advice before you make a big contribution really matters. Because getting this wrong can mean excess contributions and penalty tax that's completely avoidable with the right planning. Now here's the change that's been making headlines, and it's the one a lot of people are anxious about, even though it only affects a relatively small number of Australians directly. It's called Division 296, and it introduces a new additional tax on investment earnings for super balances above $3 million. Here's how it actually works. It's not a tax on your whole balance. It only applies to the investment earnings generated on the portion of your balance that sits above the $3 million threshold. So, if your balance is $2.5 million, this doesn't touch you at all. If your balance is $3.5 million, only the earnings on that extra $500,000 get the additional tax applied, at an extra 15% on top of what's already being paid. And if your balance climbs above $10 million, there's a further additional 10% tax on earnings above that higher threshold too. Put those together, and someone with a genuinely large balance could be looking at a combined tax rate on those earnings of up to 30 or even 40% in the most extreme cases. Now, for the vast majority of people watching this, that threshold is well out of reach, and that's fine. It's not designed to touch you. But if your balance is approaching that $3 million mark, especially if you're still some years away from retirement and your balance is growing, this is not something to leave until next year to think about. The threshold is going to be indexed over time, so it keeps pace with inflation. But if you're anywhere near it, a conversation with a financial advisor now could genuinely save you a significant amount of tax down the track. Let's talk about pensions, because this next change affects anyone who's either already drawing an income stream from their super or planning to start one soon. The transfer balance cap, which is the lifetime limit on how much you're allowed to move from your accumulation account into a tax-free pension account, has increased from $2 million to $2.1 million. Now here's the important nuance most articles get wrong. This increase mostly benefits people who haven't started a pension yet, or who've only partially used their cap so far. If you started a pension years ago and you've already used your full transfer balance cap, you generally won't get the benefit of this increase automatically. Your personal cap is proportioned based on how much of the original cap you'd already used. So the timing of when you start your pension and how much of your cap you've used historically genuinely matters here. This is another one of those situations where the rules are more personal than they look on the surface, and a blanket answer just won't cut it for your specific numbers. There are a few more changes worth knowing about quickly. If you're a lower income earner, the government co-contribution scheme is still around, and the income thresholds have gone up. The maximum payment stays at $500, but the lower income threshold has risen to just over $49,000, and the higher threshold to just over $64,000, meaning more people sitting in that income bracket may now be eligible to get the government to top up their contributions. There's also good news if you're taking government-paid parental leave, because for births and adoptions from the middle of last year onward, the government now pays an extra 12% superannuation contribution on top of your parental leave payments, and that continues to apply going forward, which is a huge step toward closing the retirement savings gap that parental leave has traditionally caused. And for small business owners, the lifetime capital gains tax cap for contributions has also increased, now sitting at just under $1.94 million, giving business owners a bit more room when they're selling up and rolling proceeds into super. So here's what I want you to actually take away from all of this. The headline rate hasn't changed. 12% is still 12%. But almost everything around it has shifted. Your money moves faster now thanks to Payday Super. You've got more room to contribute thanks to the higher caps. There's a genuine new tax to be aware of if your balance is heading toward $3 million. And your pension cap has grown, but only in a way that depends heavily on your own personal history with the system. None of these changes are simple yes or no situations. They interact with your personal balance, your age, your income, and your retirement timeline. So my honest advice, and I say this every year and I'll keep saying it, don't make big contribution decisions based on a YouTube video, including this one. Use this as your starting point to ask the right questions. Then sit down with a financial advisor or your super fund and run your actual numbers before the end of this financial year catches you out. If this video helped clear things up, do me a favor and hit like. It genuinely helps this channel keep making these breakdowns the moment the rules change instead of months later. Subscribe if you haven't already, because Centrelink Age Pension is going to keep tracking every single update to super, pensions, and retirement rules as they happen throughout this year. Drop a comment and let me know which change affects you the most. I read every single one, and it helps me know what to cover next. Thanks for watching. Take care of your retirement, and I'll see you in the next one.